Hi, and welcome back to our channel, Pay Down Debt Solutions. My name is Jen. For those of you that don't know me, and Dan is my counterpart, he also runs videos for you. Today we're going to get more into DTI. So DTI stands for debt to income, and DTI is very important, and it has been cropping up more and more lately, so I want to go over that a little bit more. I'm also going to talk to you guys about a student scenario where DTI was an issue for her and show you what we did to help lower that DTI. Now, there are many financial goals, right, that people have. And I'm going to get into the financial goals a little bit with you guys today because what's interesting is, what do you think the number one financial goal is? What do you think it is? Well, if you're reading the board behind me, you're going to know, right? And the other thing I want to talk about is how incredible velocity banking is, how amazing this whole method and this whole strategy is when it's run the pay down way. I have some comments out there, and I kind of laugh because we'll have people out there that say, this is great, but it seems too complicated. The Dave Ramsey method is proven. Okay. And yeah, it's a proven method, but you know what? It keeps you stressed, it keeps you strapped, and it keeps you feeling payment poor for a very long time, okay? Yeah, you can throw every extra penny you have at your loan and it's going to take forever. But here's the thing, you guys, a lot of people don't have the extra money to throw at their loans, right? Because yeah, of course, if you could throw extra money on your loans, wouldn't you pay it down faster? Sure you would. But if you run things the velocity way, guess what happens? You free up cash flow, which then pays those loans and lines down. And so that's what we're here to do. We're here to teach you guys all about velocity banking because we want to empower you. We want to empower you to get out of debt faster. Debt is an awful place to be, right? Being in debt is a terrible feeling. It is something that is so very stressful. And guess what? We know, right? Dan and I know because we've been there and we've done that. And I don't want to see you guys stress out about this anymore. It causes so many problems in life, right? It causes, marital strife. It causes stress and anxiety. It can even cause heart conditions, right? Or issues because you're so stressed out and you're so strapped that your whole body is like a live wire, okay? Don't do that to yourself. Don't do it, and I'm going to show you a different way. Stop banking traditionally. We're going to solve that problem for you. So you guys are going to see that video cut. I had a cat that was scratching on my door, so I had to get rid of that distraction. All right, so we're going to get into velocity banking today, and we're going to get into debt to income and the debt to income ratio, and then show you a student scenario that we're going to describe for you, okay? So how to lower your debt to income ratio, right? How to achieve your financial goals. Well, the top 6 financial goals in the United States are: number 1, get out of debt, right? Number 1 is get out of debt. Number 2 is make more money, okay? Number 3 is save money or save for retirement. 4 is become a homeowner. 5 is to launch a business. And 6 is to leave money to family, right? So leaving money to people is also very important to you, especially as you age. You want to have, some kind of nest egg for you, for yourself, obviously, but for your family. You want to be able to leave some kind of legacy to your family, all right? But the number one financial goal, not surprising to me and not surprising to Dan, and probably not surprising to you either, is you want to be financially or debt free, right? You want to have that freedom, that financial freedom, and you want to have zero debt. And that is what we're going to talk about with you with velocity banking. So velocity banking can actually help you achieve all of these, right? Because we know that time is money. Velocity banking saves you time and it saves you money, without a doubt. There's no question about that. If you learn this strategy, I can guarantee you guys are going to be out of debt faster than traditional banking. I feel confident saying that because I know how this works. The only way it's not going to work is if you overspend. If you spend more than you make, obviously that's not going to work out well for you, right? So if you run your banking through Velocity and you can give yourself those payments back, right, as cash flow, you will pay down your debts faster and you will get out of your whatever position you're in. You're going to get out faster. All right, so ways to lower DTI using velocity banking. So there are different ways that we can do this, okay? And so the student scenario that I'm going to go over with you today had some offers for her, right? So she's sitting at a 670 credit score, which actually, it's a pretty decent score. Yeah, we know that 700 and above is really where you want to be, but 670, she should be able to work with that. And obviously she can work with that because she was she was given in the mail 2 0% cards, right? 2 0% offers that she didn't think she was going to take them up on it because it didn't give her as much as she needed. All right. So in watching the channel and trying to figure out velocity banking, she kind of understood the concept. And so she contacted us and wanted a little bit of help. And so that's what we're doing here is we're pointing her in the right direction. So her goal, her end goal was to get a line of credit. Okay. She wants a line of credit. She's retired and she wants to start traveling. That is her dream. That is her goal. And we're going to get her there. And you guys are not going to believe how fast we're going to get her there. Okay. So here's the problem though. So she has an income of $2,800, right? And she has total expenses of $2,747. All right. So in this case, she approached her bank and her banker and she was declined due to her debt to income. Now, I have all sorts of arguments I can make with that banker if I were in front of them, because she's trying to lower her debt to income. And this would be part of the plan to do so, right? So remember, we always want to tell our bankers why we're there, because that can help you get your line of credit if they understand what your goals are. Now, any good loan officer is going to really dig into what you're trying to do, and then they're going to help you, and that they will show you ways that if you consolidate debts where you can get a better or a lower DTI to help you get what you want, right? So they may ask you or say, in order to get your line of credit, you have to pay off X, Y, and Z. Well, for us, that's great because that's what we're trying to do anyway, right? So it all makes sense. All right. So having a low DTI is important. Low DTI helps you buy a house. We know this, right? Because DTI comes into play every time you're talking to a mortgage loan officer. And a low DTI helps you get a line of credit, such as she was trying to do, right? And a low DTI increases your credit score, which gets you a better interest rate, right? So lowering your DTI increases your credit score. I thought I said that the opposite. Sorry, guys. All right, so that's pretty obvious though, right? Because you want a higher credit score because that always goes along with higher rates. Better interest rates, lower rates. And if you have a lower interest rate, then obviously you're paying less interest over time, all right? So in her scenario here, her income was $2,800. Her total expenses were $2,747, which left her with a cash flow of $53, okay? So it's pretty tight. Now, we know that calculating debt to income conventionally, right? So you want your debt payments. Now, again, it's debt payments. Your living expenses don't come into play here, all right? It's just your loans and lines that come into play. So it's your debt payments divided by your gross income, not your net, your gross, okay? You take that and then you're multiplying it by 100, and that gives you your debt to income. Now, in her case here, her debt payments were $1,747, $1,747, and we divide that by 3,400, which is her gross, and you multiply that by 100, and she is at a 51% DTI, which is high. Okay, so you really want to be 45 or less for anything conventional. So her debt to income is high, right? So remember those two credit cards that we talked about, okay? In her situation, now, if we change her payments, right? If we change her payments and we lower her payments, that will change her DTI. And so when she got these offers in the mail that she didn't think she was going to do anything with because they were too separate and they weren't the total dollar amount that she wanted, right? So she didn't think she was going to use them. But we changed her mind when we set up her plan, okay? So here's what we did, all right? Now, her solution here is that she wants a line of credit, but the DTI is too high. So the solution we came up with was using these two 0% offers that she had. One was a Bank of America at 0% for 15 months. The limit that they were giving her was $3,500. And the cashier's check was for a 4%, right? Remember that fee that they charge when you advance money this way. So that's at a 4%, okay? So what we did then is, knowing that we're going to take the majority of these funds, we want to use the majority of them, right? So we then took a number, we took 3,365, we multiplied it by the cash, the cash, well, it's not a cash advance fee, it's a cash, what do they call it? A convenience check fee. Okay, we multiplied that by the 0.04 because it's at 4%. So that means her payment, okay, we'll skip payment for now. But that means that her advance fee is going to be $135, right? So that check fee is $135. So her total amount that she's going to get is going to be $3,500. Okay. Now the payment. Let's talk about the payment then. So when you have a 0% card, okay, and you park your funds on that 0% card, you owe something, right? It doesn't just sit there for 15 months without you having to pay. You have to pay. And it's somewhere between 1%. Some companies will charge 1%, some charge 3%. So we actually figured this on that 3% charge just to make sure this was going to work for her, okay? And later, after she, called them up and took the offer, one of them charged 1%, but we still are going to figure them on the 3% today, okay? So that means her payment for this would be $105, all right? But she's also going to be using these as debt destroyers. So we're going to talk about that 105. Now, she got the other card, was Capital One at 0% for 12 months. And this was a $2,000 offer. Okay, so this one was $2,000. And that advance, that cash, the cashier's check, the convenience check fee is 4%, right? So that convenience check is 4%. So again, we have to turn it into a decimal. We know that if we take about 1920, okay, so we decided we were going to use 1920 and multiplied it by the 0.04, which was $77. So that took her up to 1997. Okay, so we wanted to get, now remember, you guys have to remember this though, when you have these offers, you can't go over the offer, right? So you have to work your numbers and make it fit inside the 3,500 or the 2,000. And so that's why we have to play with the numbers a little bit to know that when you're charged that percentage, you're going to fall below that fee or I mean that available balance for you. So now their payment, the payment for this card at a 3% was going to be $60, okay, $60. So that means she then has $165 that she would be adding into her scenario. Well, we're going to do something though, right? We're going to pay some stuff off. So if you take a look at her financials, okay, her income again is $2,800. Her total expenses are $2,747. All right. And her cash flow is $53. Okay. Same thing we just worked over here, right? So it's the same thing as over here. Her mortgage amount is $1,097. All right. She has a car that she has been paying on for years. This was a 5-year loan. Okay. So she has a car she's been paying on. It's $4,025. She's sitting at a $588 payment that she has had for 4+ years, okay? So that loan rate, the auto loan is at 6.75. She has 8 months left on it, okay? And she's going to pay when this terms out, okay, she's obviously paid more over time, right? But the amount that she's going to pay from this time forward, okay, is $117 on that, all right? Remember, she's already paid. So she also has a Quicksilver card, okay, and that's for $1,216. The payment on that is $34 at a 22% interest rate. 4.7 years if she lets this term out traditionally banking, which we don't do anymore. Then she's going to pay $717 in interest for that, okay? And then she has a Discover card that the balance is $876 on. Her payment's $28. It's at a 27% interest rate, 4.5 years to let this one term out. And she's going to pay $632, okay? So the total amounts that she is going to pay is $1,466 over time, right? To let these term out traditionally. All right, so that's what she's going to pay. She's paid through the nose up to this point, right? But now she wants to travel. She has some things that she wants to do, and she wants to do it now. She's ready. She's done, right? So we're going to get her there. Now, we know that the payments here, okay, our payments, if you total them up, they are this, that's where I get the $1,747. Again, the $1,747 over here, which we saw our DTI at 51%. So her total debt payments right here are $6,117. Now, what we're going to do is we are going to then pay off this car loan, okay? We're going to pay this car loan off, and we're going to pay this off, okay? So when we do that, we're going to then put these on these two cards. Now, of course, she can't put, she can take the Bank of America, put it on the card, but then she has to take a portion of the Capital One and put it on the card. And then the remainder, she's paying this off with, okay? So that is what we've chosen to do. So that is where we're getting our numbers over there that we're going to work down. All right, so we know in looking at her numbers, right? But she's going to then pick up a payment. She's gotten rid of this payment, she's gotten rid of this payment, but she's picked up two payments, right? She's picked up the $105 and the $60. So now her expenses have changed, okay? Her total expenses. Now remember, when we're working with credit cards and we're using credit cards as our debt destroyer, such as we are over here, right? So we're using them as our debt destroyer. We have to remember that it's our chargeable expenses, okay? So the chargeable expenses are the ones we're putting on the card, all right? And hers total $1,000. And ironically, and this doesn't usually happen this way, but hers was able to be split evenly, 500 and 500, okay? And we'll get to that in a second. Those are the expenses. So remember, your chargeable expenses then are what we're running through the card. So we're going to put all the chargeable expenses on the cards. We have to hold out anything that we have to pay in cash into our checking account and pay those bills off with cash through the checking account or a draft from the checking account, right? Because we know credit cards cannot be paid. You can't pay credit cards with a credit card. You can't pay loans with a credit card. Obviously, you can't pay your mortgage with a credit card. You can't pay that auto card with a credit card. And she has literally all credit cards and a car loan here, right? Which, okay, these two we got rid of. So we do have these payments here. They're required, right? So it's a required payment, even though we're using it as our debt destroyer and they come back to us. So these payments actually come back as our cash flow, okay? And I'm going to show you that. So what happens is we actually have new expenses, and that is what I've notated here, okay? So we have new expenses now because these are gone, all right? And these kind of are in its place. So how do we do that then? Let me find my calculator here. So if we take, okay, so if we take now, all right, we know that her living expenses are $1,000, okay? And that's quite obvious because we have the $1,747 plus $1,000 gives us the $2,747. All right, so let's just take and calculate. So just so you guys know, if you're trying to calculate what your new expenses are, okay? So you would then get rid of these, right? And then you have to replace them with these. So if we take the 1097, right? And we add our, so that's our mortgage. And then we get rid of this, we get rid of this, we add our 28, okay, plus the 105, plus the 60, okay? So we're adding these all up, okay? Now, whoops, let me do this again. So we've got 1097 plus, we have 28 plus the 1,000 plus the 105 plus the 60. Okay, so that's where we get the 2290 from. Okay, so I had skipped over the 1,000. So remember, so to get our new expenses, right, we know that we have the mortgage that we have to account for. So we add the mortgage, we add the Discover, we add our living expenses, we add the Bank of America, which has to be, right, that has to be paid, and the Capital One, which also has to be paid. Now, these, though, come back to us as cash flow, right? So they're actually not figured into anything because we are using both of those cards as our debt destroyer, okay? So in order to find your available income, you're taking your income, which is $2,800, you're subtracting out your mortgage, you're subtracting out your Discover, right? And we know these are coming back to us, right? So we don't include them. So you're left with a $1,675, which that is her available income that she's going to be working with. Again, there are things she has to hold out, right? She has to hold out of her income in order to pay because it can't be run through, which such as the mortgage and this Discover, okay? Now, to find her chargeable expenses, we take our new cash flow, remember, which is including these. So we take our new cash flow. But to find the chargeable expenses, we have to take the new cash flow and subtract out everything we cannot charge, right? So the 220 or the 2290 minus the mortgage minus the Discover minus the BOA minus the Capital One gives us $1,000 as our chargeable expenses, okay? So it actually equals the living expenses. But remember, these are chargeable expenses. They're still chargeable. So we always have to account for them somewhere. They don't just disappear. And you can't add them in twice. So it's not like you can subtract them here and then add them in here, right? You can't do that. So they always have to be figured somewhere, all right? So that's how we calculate this, okay? So I'm trying to make sure that that I explain this in a way that you guys will understand, because this is a real viable solution. So you guys out there that are sitting at a high DTI, this is an amazing solution for you to get those payments down, right? To get those payments down. Now, we're going to take then her $3,500, okay, so the Bank of America card, and we're going to take the Capital One card and at $19.97, and we are going to split the income, okay? So we have to split this income. And so what I did is I played with the numbers, okay? Just like Dan did in his video the other day. He said he didn't just know how to get these numbers. He had to play with the numbers. He had to do some math on it, right? He had to math it to figure out what was going to make sense. So that's exactly what I did here. So when we looked at our numbers, we decided we were going to put $900 of her income onto the Bank of America card, and we were going to put $775 onto that Capital One card, okay? And then we're going to run our strategy, all right? Now, our income, or I'm sorry, our expenses, we know are $1,000. And like I said, it was able to be split evenly, which is kind of funny, but it worked out that way. And now, this is what is so great about these 0% cards, you guys. This is what's awesome. We're not adding in any interest, are we? We are doing velocity banking, and we don't even have to add an interest because it was a 0% card, both of them. One at 15 months, one at 12 months, and we ran this down. So here's what we did, all right? So this woman was completely ecstatic when we got off the call with her because she gets out of this pretty quickly. So let's look at this, all right? She's going to be able to, number one, she'll be able to get her line of credit. And number two, she'll be able to do what she wants to do, and that is travel, all right? So here's what happens when we reveal what we did, okay? So this took her, this one in particular, this card, which was the Bank of America, took her 7 months to run down. And of course, it's at 0% interest, right? And then this Capital One card that she got takes 5 months, and again, 0% interest, correct? Now, so what did this cost her, okay? Remember, there is a cost, and that cost were these, right? Okay, so this is the cost here because it cost her something to do that 0%, to transfer everything onto those cards. So we take our 135 plus our 77, so it cost her $212, and 7 months was the longest it took versus, right, running over here, okay, at $1,466, she was going to spend another 8 months to get rid of the car, another 4.7 years or 4.5 years to get rid of these cards when she's done it all in 7 months. She can now travel. She can do whatever she wants to do. See, again, you guys, I talk about time being money. Time is money because now she can save money. She can put money away to travel. She could put money away to invest if she wanted to. We know that's not her goal. Her goal is to travel. And so look at this. Look at her new DTI, okay? In doing this, all right? So we take all of our charges, right? Our 105, our payments, I should say, not charges. Our 105 plus the 60 plus the 28 plus the mortgage equals $1,290, all right? We know her gross income is $3,400 a month. So we take the $1,290, you divide it by the $3,400, multiply that by 100, and now her DTI is 38%. She's in line. She can then go get that line of credit that she wants so that she can travel. And guess what? She's already learned a skill. She's already learned how she's going to bank from now on, how she's going to put her income in and her expenses out, and she's going to win and pay off any of those vacations faster. So I applaud her for calling and, understanding this. She's been watching videos and she's learning it. But, she got a little bit tripped up when she got 2 cards that were not the total amount. She just didn't know what to do with it. So that's what we're trying to do. And that's why I brought this video out for you guys today, because I thought it was really important to go over again. Number 1, how to lower your DTI. And number 2, how to use something when it isn't exactly what you thought you needed, right? It still worked out, and it still worked out beautifully for her. Thank you guys for hanging in here with me. I hope you like and I hope you subscribe, and have a great day. Thanks so much.